Hey, everybody, welcome back to another edition of Market Talks with Dr. Stoxx. This is Dr. Tom Carr, aka Dr. Stoxx of drstoxx.com. That's DRSTOXX.com. We've been in business every market day since October of 2002, if you can believe it. Traded through all kinds of market conditions. This kind of stuff we've been seeing lately is pretty tame in comparison to what we saw in 2001 and 2008. Anyway, we will manage here. So we're going to look at some index charts. We're going to look at. Also going to drill down is what I really want to do. Drill down into the hourly, 2-hour charts and see if we can figure out the next likely leg of this current market that we're in. And I have a couple of charts I want to show you, very strong breakout charts or near breakout charts or up near 52-week highs, which is quite unusual in a market where things are not near 52-week highs, usually a little bit lower. And but there are some strong charts out there. I want to show those to you. And then I'm going to take some chart requests from some of our members here. So let's go ahead and get started. By the way, before I leave this page, this is our homepage, drstoxx.com. If you're interested in joining us in the live trading room, which is where this is coming from, go to drstoxx.com, click the subscribe button, scroll down to live trading room. You can add on the live options room, brand new. It's been out just about 2 months for another $30 a month as a discount. Okay. Now, no, first things first. Let's go to, I lost it. Here it is. Okay, this is, whoops, we don't want that. Homepage of finviz.com, your one-stop shop for all things stocks. And you can see that we are red today all across the board. Small caps leading the way lower, down 0.8%. Strength is in the Dow, which is typically where strength is on a weekday like this. But it was a much weaker open. We had a really sharp fall prior to the bell today on some really, really nasty economic data that came out at 8:30 a.m. and then again at 9:45 and again at 10 o'clock, and very little of it. One exception, very little of it was bullish. Everything looked pretty negative. So market gapped way down, but as these things go, we're sort of in this buy the dip mentality right now. It bought back up. We haven't quite closed the gap. I'm not sure that we will, but we're well off the lows of the day. However, I'm going to show you the charts, and I do think we are in a transition. So we had this. Well, anyway, I'll explain later when we get to the charts. This is the thing I wanted to show you today. The data. Okay, we had mortgage apps, which came out a little bit well above last year, but still a negative number. And I tell you, we've got a lot of friends here we've got a lot of friends here in the real estate market, and it is a very tough, sluggish time for them. Nobody's really selling. Nobody's that interested in buying because mortgage rates are still pretty high. Inventory is low. Yeah, it's just not a good time to be in the real estate market. So no surprises there for another negative on the mortgage apps, but this is the biggie. ADP employment change, which is an early read this week on new jobs being created, and businesses are not hiring. They're just not. Why? Because of tariffs. They're not sure how high the tariffs will be. They're not sure how widespread the tariffs will be. They're not sure if their supply chains are going to get disrupted. They're not sure if the goods they need, the products from China are going to come in. All kinds of unknowns, all kinds of question marks. And so, hey, you're not going to hire a bunch of new workers in that sort of environment if you don't know what your growth prospect is. So, of course, low number. We expected a 128K. We got 62K, which is well below the 147K we saw last month. So this is a tariff effect. Now, I've been saying this again and again and again, and I'll say it now. If Trump can do a course correction on tariffs, we will see these numbers rebound sharply, and we will see the market rebound sharply back up to all-time highs. But we're not there, and everything that's been coming out of the White House and his advisors, economic advisors mainly, hasn't been very hopeful for short-term effect. He's been talking much more about tariffs being in place for a year, 2 years, or longer. So yeah, market's kind of scratching its head. All right, GDP negative. We expected an increase of 0.4%, negative 0.3%, way below the big bump we got last month, 2.4%. Why is that? In a word, tariffs. So everybody's buying stuff from China, buying from India, buying from abroad, buying European goods, stocking up because we just don't know how high those prices are going to go once the tariffs are in place, right? We're in this 90-day pause. We're about a third of the way through that, I think. And when we get to the end of that, nobody knows how high those prices will be. So everybody's buying from abroad. Imports, not much in the way of exports, and that's causing the GDP to crash. If that happens again next month, we can call that a recession. But I'll tell you what, the same thing happened during the Biden administration, 2 quarters in a row of negative GDP. Did they call it a recession? No, they didn't. They had a way of explaining it. Are they going to call it a recession under Trump? Probably. That's just how these things go. All right, it is what it is. We'd have to keep an eye on the charts, not so much on the political landscape, but on the charts, and the charts will tell us what we need to know. So what else do we have? A GDP deflator, which is a not well monitored number, but it is an indicator of inflation, right? It came in really hot. So when you factor out certain stuff, I don't know how it works. I don't know what goes into the deflator, but you take out certain things, and the number that results, if it is much higher than the GDP itself, it is a sign of inflation. That's not a good number, right? It's a bearish number. Employment cost index was in line. Chicago PMI, which is a production manufacturing index, was negative. Anything below 50 is contractionary, right? It's the economy is getting smaller, not bigger. We had a 44.6, which missed the 46 estimate, which is well below the 47 we had last month. Okay, income was up. That's good. Spending was up. That's good for the economy. And PCE prices came in line or below estimates. That's good. That gives the Fed a green light to cut some rates. That's the second thing that could happen that could really trigger a good, healthy rally in the market and get us past a lot of this tariff worry and the recession worry, to see the Fed get very aggressive on rates. But they're not there yet. We have a meeting coming up next month in May, which starts tomorrow. May starts tomorrow. And I think we'll get a quarter cut. That's kind of where the market is leaning right now, but we need more than that. We need really a good 50 basis points cut. And the Friday jobs number might push them in that direction. So we'll keep an eye on that. All right, enough about that. Let's take a look at some charts. So again, we're trading against let me just check one thing. We're trading against a macro environment that is very uncertain, right? We're starting to get a little bit of revelation here about, some countries are starting to negotiate. There are some people coming to the table. India looks like it's ready to ink a deal. We keep hearing little bits and pieces about China, which is probably the biggest concern that everybody has. But really, a lot of stuff is being kept under wraps, and we don't have a clear picture. Okay, so here's what the market has done, right? Tariffs came out very explicitly right at the end of March and caused the market to crack down over 20%, triggering bear market concern, right? Anything under 20% is bear market. But everything happened so fast and it was so extreme, right? Because market wasn't ready for tariffs. It wasn't ready to price it all in. Everything happened so fast and so extreme that we triggered all kinds of extremely deep bearish sentiment indicators, stuff that we haven't seen for decades, and in some cases, historic lows. And that's typically when you start to see the market stabilize a little bit and even get a good, healthy bounce. So that's what we've had. We've had a nice, healthy bounce, not because the economy has gotten better, not because the tariffs situation has gotten more clear. There have been a couple of back pedals, I have to say. So at least Trump is helping out the auto industry a little bit. He's talking about cutting the China tariffs in half. I'm not sure if that's even happened, but there are a couple of backpedals that's helped as well. And here we are. So we rallied, about the market went down 20% in April. It rallied all the way back up yesterday, 19%. Down 20, up 19 in the same month. That is probably a record, unless maybe 1929 or October 87. But I think that that's got to be a record of some kind. Now, we are still, this is the S&P 500. We're still under the falling 50 period moving average. The LRC, the linear regression channel, which measures 2.0 standard deviation on either side of the trend, is still heading south. The 21 EMA is starting to tail higher. That's a good thing. We're trading above the EMA. That's a good thing. And we started to see this volume right in here is just totally crazy. Just huge volume. And it was green one day and red the next, and green one day and red the next. But in here, this little pocket right here shows some very good, consistent buying. It's not above average. It was actually a couple of days below average, but it's starting to look stable, right? Things are starting to look more stable. However, I still think that my map is, one of two things are going to happen. We're going to get a little bit of a retest early May, a bounce to test some of these recent highs, maybe even get up to about that level, wherever the 5,800, right? And then if things toward the middle to latter part of May haven't gotten sorted out and we don't have 50 basis point cut from the Fed, I think we're going to see another leg lower into early June. Yeah, I don't see any other way around it. So let's play this. We're going to play this little pause, little transition into some discounting, right? And we do have some big earnings coming up tonight. We have big earnings coming out tomorrow. We've got all the jobs data coming out tomorrow and Friday. So a lot can go wrong and a lot can go right in the next few days. But I do think we'll see a little bit more volatility, and then we'll hit sort of the bottom of this range, right? We're in this little tight range. Let me show you the range. There's your tops. And here are the range lows. And I think we'll probably stay within that yellow box for a couple of weeks. And then if things are starting to get clearer and we're getting some good support from the Fed, and maybe we've got a China deal on the table, I think we could break out and get right back on track. And that would be a really nice market to trade, because there's going to be a lot of really great setups. There's going to be a lot of good value out there. But if none of those things happen, and if we get stuck, if let's say Congress can't really get a good tax bill, because that's another big tailwind potential. If Congress can't get a good tax bill through, then yeah, we might still have another leg lower. Now, just to throw this out there, I have a guy in my pro trading group who does cycles, and he's been calling for another leg lower for some time now. He's had to, because the market's got a little higher for a little longer than he thought was going to happen. He's revised his cycle analysis, but he's talking about the 5th to the 6th to the 7th, 8th, 9th of May, somewhere in there, like later next week, early the week after. He's talking about a new leg lower. So if he's right, and he was very right about the crash in late March, early April, he was very right about this whole leg lower right here. And he's been right so far about this bounce, very right about the bounce. It's just that it's lasting a little longer than he thought it would. He thought the crack, the new leg lower would start like yesterday, today, tomorrow, maybe somewhere in there. Okay, so that's just that said. Let's look at the NASDAQ. So we're right up against the 50-period moving average. We tested it yesterday. It held. We gapped lower on the data this morning. Came all the way down to the 21-period moving average, which is tailing higher, which is a good thing. Tagged it, bounced back up. That's a good thing, right? We want to see these bullish bounces for a good sort of healthy technical macro to trade against. But we're still under the 50. We're still below yesterday's high, and and if I were to show you some, some oscillators on here like the stochastics, you don't see it in the RSI so much. We're starting to get a little bit of RSI bearish divergence, but you'll see it in stochastics. Here's the MACD histogram, and it's really high, right? This is really, really high, and that tends to precede a pullback. So, but we're not seeing bearish divergence, right? I've got the divergence indicator on here, and we haven't had any bearish divergence on any of these pivot highs. And we could get on this one because it would be relative to that one. So we're not seeing bearish divergence, but we are seeing some overbought conditions on this rally. And again, everything is moving from the northwest corner to the southeast corner. And that's a bearish posture, and it's going to be a long while before that starts to change, right? Because when you've got the LRC, right, all these high prints up here, these high prices start to drop off the back end, and then these lower prices down here start to get added onto the 100-period look back. You're not going to get the angle of the LRC starting to flatten out. Not when that happens. We're going to have to see higher prices on the right end, and have to start including some of these lower prices on the back end. When that happens, we can start to see the LRC begin to flatten. But until then, yeah, it's not looking really good. Okay, I would keep an eye on the small cap index, because let me get rid of all this stuff here. Keep an eye on the small cap index, because if it can rally against the headwinds of tariffs, anything can rally. It will also be a barometer for how scared the market is of tariffs, so of recession too, because both of those things are worse for small caps than blue chips and big caps and mid caps and all the rest, safe havens and so on. Okay, so here's the thing that it did today. It took out yesterday's low. It took out Monday's low. It took out last Friday's low. So it's starting to undercut the near-term trading range, and and it's still it hasn't taken out yesterday's high. So here's a little tip, by the way. Here's a little tip, and I learned this from a friend of mine who unfortunately passed away about a year ago. But he developed a way of categorizing candlesticks in one of three types, and then he has all kinds of formula for figuring out, is it likely from here to continue in the same direction, or are we looking at a reversal pivot? So there's the inside day bar, right? The high and the low today the high is lower than yesterday's high. The low is higher than yesterday's high. That's an inside day bar. That's a number one. And a number three bar is just the opposite. The outside day bar. The high today is higher than yesterday. The low is lower than yesterday. That's an outside day bar. We're not talking about the body of the candlestick. We're just talking about the high and low. And then that's a number three. Number two is a directional bar. You've got two up and two down. Two up is when the low is higher than yesterday and the high is higher than yesterday. That's a two directional up. And it doesn't matter if it's a green bar or a red bar. It just matters about the high and low. And then a two down, of course, is just the opposite. The high today is lower than yesterday's high. The low is lower than yesterday's high. Okay. Now, he has all kinds of ways. There's a 2-2 reversal. There's a 3-1-2 reversal. There's a 2-1-3 reversal, and all kinds of other things. I don't know exactly what they are, but he's got a whole system. Here's one of his reversals that I know. If you have a 2 bar, which is what yesterday was, right? Yesterday was a number 2. It was a 2 up. When you have a 2 up, where the high is higher than the day before, the low is higher than the day before, that's a 2 up, followed by a 2 down, which is today so far. And this could change by the close, but today's high is lower than yesterday's high. Today's low is lower than yesterday's low. And when this comes at the top of an uptrend, that is a reversal pivot. So let's keep an eye let's keep an eye on the small caps. Here are your four canaries, right? The things that I like to monitor, and sometimes get away from this, but if you monitor the small caps, the TLT, which is your 20-year bond, Treasury bill bond, as a safe haven, um, ARKK, which is your good proxy for risk on trading. If the market's really looking for big alpha, risky assets, growth names, maybe stocks with not a lot of earnings, biotechs, AI plays, quantum computing, and all this stuff, look at ARKK because that's a fund that is just loaded with all that kind of stuff, and a lot of Tesla, in fact, as well. So ARKK and what was the biotechs. So you look at those. If you've got small caps, biotechs, and ARKK rallying hard, you've got a good, healthy risk on environment, and everybody's happy, and the market's happy, and nobody's worried about the market falling. But if those guys are all red, and then you've got bonds green, right? That's a bearish signal, and tends to say that at least today, at least for the day, we're thinking more bearishly. Okay, right now, where are they at? We've got red ARKK, we've got red small caps, we've got green biotech. That's interesting, and we have red bonds. So mixed signal. I'm not sure what to say about that, but it's a mixed signal. Okay, let me wrap this up because I want to get some chart requests in before we quit. I think Bitcoin is going to have a little bit of a pullback. We're up here at the 2.0 standard deviation. It is still in a downtrend. Volume is actually leaning a little bit on the bearish side, but we're starting to see some. When you see OBV giving bearish divergence, that's important because that's a volume indicator. And if volume indicators are leaning bearish, then it's going to be difficult for Bitcoin to continue higher. But I do think that it's going to do well eventually. It is in part a function of what's going on in gold, because if gold is doing really well, everybody gets out of Bitcoin, goes into gold. A part of a function of the US dollar. If the dollar is weak, everybody plows into Bitcoin. So you keep an eye on those two things, and you've got a pretty good sense of what the demand is for Bitcoin. But just on a chart basis, I think we're ready for a little bit of a pullback, maybe back down to about 88. And then a base should build above the 50-period moving average. And then we can start to talk about a new leg higher, We are short, we were short oil. I sold that a little too soon, of course, as always, but we took some very nice profits on that. And we shorted instead the energy sector, which is pretty much of the same kind of play. And both of those are doing really well. Oil is, I hate to say it, but it's flagging recession, and it's trading on the GDP number. If you've got a shrinking economy and a very weak labor force, which is what we have right now, it may be very temporary, but that's what we've got. And then you've got inflation coming on with tariffs being added to prices. That's a horrible scenario for the market. And of course, that's being reflected here in oil. Oil is telling us that people are going to stop traveling, people are going to stop driving around, people are going to stop production, right? Oil, energy, all related to production. Everything's just going to start to slow down, and demand is going to drop like crazy on oil. And, who was it that came out yesterday saying $60 a barrel when it was up about 63, 64, and it hit 60 and it just has continued. It just keeps going. It just keeps going lower. Now we're down to 58. All right. So keep an eye on oil because it is a good barometer on recession fear. And right now, big three red sticks, heavy volume coming in. And this is the one we bought. We bought ERY, and it is the leveraged inverse fund for energy. And it's right about the same price we bought it at this morning after having taken our profits in oil. But you can see a big breakout here, uptrending LRC 21 above the 50, pull back into the midline of the LRC, and a nice rounded bottom. Rounded bottoms always more bullish then V bottoms, and nice breakout today above the 21. So I think the energy sector, very weak today. It's the weakest sector today, likely has more weakness ahead. Um, Gold. So gold is doing this nice looking flag, bull flag, almost perfect. I mean, just doesn't really get any prettier than this. And this is up near all-time highs. It did hit some bearish divergence coming in a little bit, but the fact that it's not falling and going sideways instead, we're still up in the upper quadrant of the LRC. We're above the 21. Everything is rising. The MAs are stacked. This looks really good for now. We're coming into the apex of when you get close to that apex, right? The closer you get to that apex and the tighter the price gets inside there, the bigger the breakout. That's a theory. I mean, it doesn't always follow that way, but that's the theory. So I think there's going to be a good, healthy upside move in gold. Gold is also a good play on recession, inflation, and a Fed that is reluctant to cut rates as much as they should. All right. So I like gold. I also really like the miners. We're long the miners in both rooms, right? Calls in the options room, leveraged index fund in this room. And it's looking a lot like gold, hit all-time highs. I think they're all-time highs, and pulled back into the 21. Everything is rising, stacked MAs, holding the 21 EMA. And yeah, so we'll see. Falling oil is good for miners because they use a lot of oil in their production, digging, mining, smelting, all that stuff, transport. So falling oil helps their margins, and the price of gold, of course, will only help them. Let's take a quick look at silver because I haven't looked at silver for a while. Wow, big drop down. Look at that. 2 smackdowns on overnight whatever happened there. And then a relief rally back up, holding the 21, the 50. It's not as good as gold. I think gold is the better play. So we'll keep an eye on that. The small caps, and not the small caps, the semiconductors are rallying back today, but it was an ugly overnight trade for the semiconductors because of SMCI, which is the biggest customer of NVIDIA. And they also are somehow connected to Intel, AMD, Qualcomm. They were all way down last night on a huge miss in SMCI. I think it's come back a fair bit, as the index has as well. But yeah, another place where we're seeing a lot of reality getting put out there, and the market isn't reacting to it, at least not like you'd think they would. So either the market knows something that we don't, which is always possible. And by market, I mean the big players, right? The big investment banks, the hedge funds, the well-pocketed, deep-pocketed players, the fund managers. They know something that we don't, or they're trading light, and the retail is bouncing this back up. Now, I did read this morning, hedge funds have been selling this rally. What are some of the big firms like J.P. Morgan and Goldman Sachs and so on, also getting lighter and lighter on equities. So that usually happens, right? You get the bear market, and then they don't always hit the top, but as the market is falling, they get lighter and lighter and lighter on equities. And then when you see the market about to bottom, that's when you start to see them ticking back up in terms of their equity exposure. We haven't seen that yet. Not in the big guys, right? In the smart money, we're not seeing them tick back up. They're still down there, pretty light. So they've been pretty much out of this rally, which is obviously a concern, because if smart money's not buying the rally, should we be buying the rally? Okay, well, we'll see. It's just a typically when you, like the 2008, we knew the causes, we knew what the problem was, we knew kind of what would be needed to fix it. It took some time to fix it. There was a lot of fallout, right, with all the big bankruptcies, but we fixed it. And we knew what the problem was, and we knew what the cause was. We knew kind of the impact on the economy, and it got all priced in. And then once we hit the equilibrium in 2009, it started to come back. Same was true for COVID. We knew exactly what was going on with COVID. The numbers were there. We just had to price it in. It was painful while it fell. We also knew it would likely be temporary, but it still wasn't sure, especially in March and April when the market started to stabilize. But we knew the cost. We knew what the cost was. In this case, we don't. We don't know what the ultimate cost to the economy is going to be for tariffs because the numbers aren't there. We just don't have the numbers yet. So that's a concern. I think that's why the big boys are still staying on the sidelines. Now, that can be a positive thing because if we do get a reversal from Trump or we get a big China deal, you're going to see them jump back in, and they're going to jump back in with size, and they're going to overwhelm the market, and you're probably going to see just a massive face-ripping rally. But we're not there yet. We're really not there yet. Okay, what else can we talk about? I don't really want to look at the mags because they're all coming out with earnings, and they could be up 10% or down 10% tomorrow or Friday. So we'll wait to see how those come out. Let me jump over to the live room, and I've got let's make it about 10 minutes. So if you want to start typing in ticker symbols that you're interested in or you'd like me to do some analysis on, go ahead and type the ticker symbol in Trading Main Room. We'll see how many we can get through. Here's the first one, ESLT. All right, I don't know this company at all, but I really like this chart. I really like this chart. It's got a lot of gaps in it, so I'm going to assume that this is maybe an ADR, right? It's a foreign company because a lot of those will trade in their country and then gets priced in overnight. But very nice looking chart. And if you're kind of wondering why does it look so nice, I mean, what is it about this chart that looks nice? Here's some very easy ways of discerning when the chart is healthy, the company is healthy, the price is healthy, the market for it is good, the demand for shares are good. You're going to see these things. You're going to see the LRC moving higher, right, which is clearly the case. You're going to see every dip to the pink zone getting bought quickly, right, which is more or less true. You're going to see the 21 EMA rising above the 50 EMA, and one or both of those should be rising as well. Let me throw the 200 on here because I don't have that on my chart. SMA, moving average simple, and then we need to get over here and let's make this thick. Input 200. Okay. So the 200 you can see is way down here, right? Way down here. So 200 is below the 50, 50 is below the 21. That's a stacked MAs. Just beautiful, beautiful chart. All right. I would say this could actually be bought right here. You could buy it right here. And yeah, what are your targets? Well, you would put your stop. I would put my stop underneath the last three lows, the last three pivot lows, about 377.50. And your initial target is going to be this little volume shelf right here because it came up here and pulled back. It got up there again and pulled back. So about 411. Now it's already 394. So it's not a whole lot of upside, but I think there's a pretty good chance. Don't know the industry, don't know anything about the company, but a pretty good chance that it's going to break out of that and start to continue higher. And if that's the case, then let's say it gets up to here and if 412, 413, and you're right around the midline of the LRC, what's your target going to be on that breakout? Your target's going to be the blue zone up here. So if it gets into that blue zone, that's where you start to take off some profits. That looks really good, really, really nice. Which reminds me, I forgot to show you a couple of other charts. Let me show you a couple of nice setups from... This is Market Surge, IBD product, Investors Business Daily product. Let me run my scanner first. Oh, shoot, where did it go? Hold on. There it is. IBD filtered. So the top two stocks here at the top of the IBD 50 list, and I have them filtered, so only 15 came through. I filter them by earnings growth and margins and a whole bunch of other things. And in a very good, healthy bull market, you're going to see that number not 15, you're going to see it at 35, 36, 37 of those 50 coming through with flying colors. We only have 15, which means that the IBD 50 is not very good right now. It's not in a healthy place. But look, Axon is a cybersecurity play. That whole sector's been really good, and it just broke out of this nice rounded bottom cup, right? Rounded bottom cup, kind of printing a little bit of a handle here. It's down around 600, and 716 is your all-time high. It's got a lot of good upside, a lot of good upside. So I like that one. And LRN is the other one I like as well. So LRN, right at all-time highs. This is a pretty quiet company. It doesn't trade. I mean, it doesn't move a whole lot throughout the day, but it is on the verge of breaking that that level right there, which is around 145. Where is it right now? It's at 143. And you can see, look at this volume. This is because it had earnings last night, and the earnings are very good. 273% today, above average volume. A big blue stick right there shows you that. Everybody's piling into this one. So this is a nice looking uptrend. Let's put it up on, let me get back to the other charts. Hold on, there we go. So here's Axon. Axon? Okay, well, this isn't looking as healthy, is it? All of my indicators, my trend indicators, not that great. So I guess I can't recommend it as a buy right now. The 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 IBD chart, which takes a longer view of things and it incorporates relative strength and fundamental strength, is looking pretty good. But the short-term chart, 100-period look back, is not very good. Like the rest of the market, it's all kind of falling. And we're up here at the blue zone, and we've got bearish divergence working in. It's not a buy. I take it back. It's not a buy right now. Let's give it a couple of weeks and see where it's at. LRN, I think, is. Yeah. LRN is in a good space. Stacked MAs, recent 21 over the 50 cross. We've got a breakout today on earnings, which is always what you want to see. You want to see a good up move on earnings that holds and doesn't come back down. And it's not an exciting stock, but in this market, we'll take it. We will take it. Okay, so I can recommend LRN. What else are you guys interested in? MSTR. All right. So I looked at this one earlier today. I did say that it's got earnings tonight, so I wouldn't be in it over. Well, I guess, MSTR, MicroStrategy, or what is it just called, Strategy now, is a company that is just, you only buy it for the Bitcoin asset, which is its main thing. They don't have a product. They don't have sales. So I don't know what they're going to report on earnings, but it's an interesting play. But I do think that Bitcoin is going to be a little bit soft next week or two, especially if we see market volatility. And then middle of May or earlier, maybe even next week, we should see Bitcoin get back on track. So I would wait a little bit on MicroStrategy. That said, it's not a bad chart. The MAs are stacked, right? 21 above the 50. They're all rising. That's good. And we've got a nice breakout, recent breakout. This is not like an all-time high because the stock was really, really up there a long time ago. Recent breakout of what is kind of a double bottom, and it looks good. Yeah, it looks quite healthy. I would say hold it. I've never really held MicroStrategy over earnings. I don't even know. Like, this was supposed to be an earnings miss. Didn't really do much to the price until a little bit later, but then it came down with the rest of the market. Here's another earnings miss, which had a few days of downside, which is kind of what I think you're going to see over the next week or so of MicroStrategy, something like this. A little bit of a pullback just to consolidate, to discount, maybe test this line again, 340. But if you don't mind holding through that, if that happens, then it's certainly a hold. I wouldn't be a buyer today, but I do like it. I think 2 or 3 months from now, this could be 50% higher or more with Bitcoin cooperating. CLS, So this is an interesting one because it used to be on the IBD top 50 list, and it used to come through some of my robust growth stock screens in Market Surge. And I haven't seen it for a while. Why? Because it's kind of not doing very well, but then most of the market isn't doing very well either. It is past earnings. That's good. Looks like earnings were a beat. That's good. Market isn't really that impressed because it hasn't been buying up, but it is, I don't know if that's a gap up into earnings. Why did that gap up? Anyway, but let me just say this, that this is something that I pointed out on the social media boards um, yesterday, I think it was. That's a neckline. Here's your left shoulder. Here's your head. And we're starting to see potential for a right shoulder. And this is nicely formed, right? You've got a deep left shoulder, you've got a shallow right shoulder and a nice deep head that comes all the way down into the pink zone. Some good bullish movement up, some good volume going in. So I think if it can hold in this area, I would kind of nibble. I would like nibble on this, and you could put your stop just below the 200 period moving average, 77.7 or so, and then just let it go. Yeah, I think that's got some good potential for a bottoming pattern that will break out to the upside. But it's not there yet. Hood has earnings tonight. Not so sure I would be in this one over earnings. Let's see how it's done before. There's a big gap up. That's good. The gap, and then it cracked with the rest of the market. Here's a big miss that went down hard. And here's a beat that didn't do anything. I mean, it rallied after, but it didn't do anything on earnings. And there's a gap and crap. So typically, a stock that has a good earnings report that's still a little bit problematic is going to get this kind of a response, right? So if you can play the gap, just have to sell it right at the open the next day, just to take your profits and move on. But I wouldn't be. I don't think I'd be trading Hood over earnings. I don't know. I mean, the chart's not bad. So the chart is slightly uptrending. We've got the fresh 21 over the 50. The 50's falling. That's not so good, but we are above the 50. We're above the 21, well above the 200. And volume looks kind of mixed, right? Not that great, but down here at the bottom is really, really good. And Hood's been getting some good press. So they're coming out with new product line. They're getting into crypto. I've got my son, my 14-year-old son, who wants to open up an account. So I know there's a lot of interest among that set, right? The young group that is, they don't have any money, but they want to get into trading. So I know that it's got some good things going for it. I just would maybe wait until tomorrow. And if it does pull back, right, there's a gap right in here. And if it goes back below the 50 or 21, I would wait until it gets back up above those guys. And, that's just technical analysis 101. But if it goes higher, don't buy it the morning after earnings, because that gap and crap potential is really high. So let it cool off for a couple of days, and then we'll see. I did report, though, that there is a lot of heavy call flow going into Hood. Not huge. We've seen a lot bigger in Hood, even during, like when it has a good rally, you'll see a lot of heavy call flow into Hood because it's a good mover. But it's interesting to note that there are people that are bullish on the company going into earnings. Not everybody. There were some big put flows as well. Let me do two more. AVGO. Okay, so we're long AVGO in their wealth building portfolio. We're showing a nice profit now after this good rally off the lows. And I have half a mind of just kind of getting out of it, but that's a little bit more about my worry that the market's going to print another leg lower. And right now, there's no real guarantee of that. And in fact, the charts aren't really leaning in that direction either. So I think we can hold it. To me, it's a hold. But if I weren't in AVGO, I would be interested in this little breakout move here. So we have the sequence, my old sequence: lower low, lower high, lower low, lower high, lower low, lower high, and then a higher low. Oh, that breaks the sequence, and then a breakout above the most recent pivot high, which typically, I don't know what the edge is here, maybe 58%, 62% maybe of the time when you see this pattern after a pretty prolonged downtrend, that is the bottom. The bottom is in. It doesn't mean it's not going to go a little lower, but it's not going to violate the lows down here around 140. So, but of course it's way up at 191. We don't want to see it go down to 140 in any case. Yeah, I actually like it. The fact that it got through SMCI was really horrible last night over during aftermarket hours. Bounced back up, hardly showing a loss at all today. I think all of that's good. All of that's bullish, and it is kind of doing a little flag here. I'm not gonna call it as a swing trade, but I would say hold it if you're already long, and if you really want to buy it, I'm not going to stop you. How about that? How about that for some ambiguity? Let's do one more. Tesla. Oh boy, Tesla. So we're short Tesla as of yesterday, and that's working out so far. And we shorted because this little bearish divergence marker here was on the previous bar, yesterday's bar. It's just moved over to today because now we have an official pivot point right there. And it gapped down today. It kept on going lower, and has bounced back with the rest of the market. But yeah, I think so. This is my map for Tesla, and I have it pulling back to test somewhere above the trend line that it broke out of. It broke out to the upside. That's good. That's bullish. That's very bullish. And when it's still downtrending like this, you're more likely to see that trend line get tested. But as long as it stays above, it should continue higher. Just that it's got a lot of work to do to overcome this downside momentum. And we also had news out today that Trump wants Musk. I think this is right. Wants Musk to stay on as long as he wants to with Doge, and the market was kind of hoping he was going to quit next week and go back. So that might be a factor. I don't know. Tariffs are going to be a factor. We don't know what those are yet. And yeah, so still a lot of unknowns with Tesla. But I do think that just from the technical perspective, I'm long Tesla, by the way, but a long-term holder, about 8 years now in Tesla. And I do think it's going to be I don't know how, I won't give you a number. I won't do the Kathy Wood thing. You give you 4,000 or something. But I think with Optimus, with the robo-taxi, with who knows what else Musk has up his sleeve, it's a very good place to be for your growth capital, your high-risk capital. It's a very good place to be for long term. My average price is something like $32. So I'm happy with this price up here, $279, and I'm happy to hang on for a long time. But on the short term, pullback, stable, hold, and then bounce from there. All right, guys, I'm going to let you go. God bless everybody. Have a great rest of the afternoon. I'll see you back in the room in a little bit after I produce this video and send it over to the YouTube channel. God bless. See you soon. Bye for now.